So what exactly is liquidity? Liquidity is an important concept to understand about financial markets. It is something that impacts not just FX, but all asset classes. So what is it? Think of liquidity as the oil in a car's engine. Just like an engine needs enough oil to function properly, the market needs liquidity. Without enough oil or liquidity, an engine becomes sluggish, right? It overheats and can even seize up. Now, just as oil reduces friction in an engine, liquidity helps reduce friction in financial markets, allowing for efficient price discovery and smoother trade execution. In simple terms, liquidity refers to how easily and quickly you can buy or sell an asset without significantly affecting the price. The more buyers and sellers are actively trading in an asset, the more liquid it is. We can break it down like this. When there is more liquidity or market participants actively trading an asset, it usually means tighter spreads. This means the spread, which is the difference between the buying and selling price, is smaller for higher liquidity assets, making it cheaper to enter and exit your trades. Spreads are usually wider for low liquidity or illiquid assets, leading to higher trading costs for them. Now, if you are completely new to trading, you might be asking yourself, what is a spread? Now, when you look at a price chart, there are usually two prices you need to be aware of. The top one we can see here in red color is the ask price, and the one below that in blue is called the bid price. Now, the spread is the difference between the buy price or ask and the sell price, the bid. It's basically the small gap between what the market is willing to buy something for and what it's willing to sell something for. You can think of the spread as a built-in cost for placing a trade. As soon as you open a trade, you're down by the amount of the spread because you bought at a higher price than you could immediately sell at. Now, when you place something like a buy trade, your buy trade will always be opened at the ask price and will always be closed at the bid. And when you place a sell trade, your trade will always be opened at the bid price and be closed at the ask price. Now, this difference is crucially important to understand because the spread will impact where your trades are opened and where your trades are closed. Let's take a look at this chart as a very quick example. Here we can see that the price for the Euro-NOK currency pair was trading at 11.51. Now, even though the current price was at 11.51, we can see that the ask price at the time of trading was trading at 11.52 with a spread of about 11 pips. We'll get to what pips mean in a minute. That means if you want to open a buy trade when the price was at 11.51, due to the spread, your buy trade will only be opened at 11.52 to account for the spread. This is not just important to consider when opening trades, but also very important to consider when closing trades. In this simple example, a trader placed a sell trade, on the NOK-Yen currency pair. The sell trade was opened at 14.27 with a stop loss set at a price of 14.31 and a take profit set at 14.12. Now, if you don't know what a take profit and a stop loss is, don't stress, we'll get to that in a minute. Now, notice that even though the price moved past the targeted closing price, the trade wasn't closed. The reason for that is because a sell trade closes at the ask price. So this trade will only be closed at the targeted closing price of 14.20 when the price moves low enough so that the ask price, which is the red line, reaches that same level. On this chart, you can see that the ask line was trading at 14.206 at the time. So that trade wouldn't have been closed at the take profit. In other words, it's only when the price has moved low enough so that the ask price hit that same price level of 14,200, only then the trade will be closed at the targeted price. This is a very important to understand concept as the spread can make a huge difference between a losing trade and a winning trade. So, coming back to liquidity and why it matters. Here's a quick visual of why liquidity matters so much in the context of spreads. This chart is the currency pair dollar-yen on the left and a chart of copper on the right. Notice that dollar-yen has a 1 pip spread, while copper has a much wider spread of about 83. This can make a huge difference in the outcomes for trades. And this is why so many traders prefer to trade markets like major FX pairs that have much higher liquidity. There's a huge difference between having a buy trade open here and having a buy trade open here. Very simple concept, but very important to understand. The second reason why liquidity matters is due to trade execution. The higher the liquidity, the better the trade execution. With more market participants, orders are more likely to be filled closer to the intended price, reducing the risk of being filled at unfavorable levels. You see, in markets with low liquidity, traders run the risk of biggest slippage, leading to trades executed at worse than expected levels. So what do we mean by slippage? Slippage occurs when there is a mismatch between the expected price and the actual price at which a trade is executed. This happens because market prices are constantly changing due to supply and demand, and in a fast-moving or low liquid condition, price shifts can happen much faster than orders can be processed. In highly liquid markets with stable price movement, slippage is usually smaller because there are plenty of buyers and sellers to match orders smoothly. But in volatile or very illiquid markets, prices can jump between order placement and execution quite erratically, leading to a different full price than expected. This means that when you place an order, your trade might be executed at the next available price, which could be higher, lower, or the same price than you intended. Let's do a quick explanation of how this works. This is a chart of gold. Now imagine for a second you wanted to buy gold, but you are trading at the same time as some very important US economic data is about to be released. Now imagine you press the buy button just as the news comes out, and immediately within a few split seconds, price gaps higher as market volatility ramps up due to the news event. Now this awkward gap in the price is what we call slippage or a price gap. Now, because price jumped up or gapped higher within a few milliseconds after the news release, it means that your buy order that would have been filled down here will now be filled all the way up here. It'll be executed at the next available price, which isn't 3203, but 3216. Now, this is a very simple but very good example of why trading products with higher liquidity is often preferred by many traders because it limits the amount of slippage that a trader might experience. However, it is impossible to avoid slippage regardless of what asset class you choose. So it's always a risk worth being aware of. Now, the other benefit of high liquidity is overall price stability. High liquidity means prices move more gradually and predictably, whereas illiquid markets will often see wild price swings. In other words, lower liquidity leads to more erratic price behavior or more volatility. Now, these two charts is a great way to visualize this. On the left, we have the euro-dollar currency pair, and on the right, we've got the euro-NOK currency pair. Now, both of these two charts is a 1-minute time frame chart. Both of them has the euro as a currency, and both of them is showing us the exact same time of day and trading session. But just look at how different both of these two charts are looking. The euro-dollar on the left saw gradual price moves throughout the session with smaller candles and far less volatility. The euro-NOK on the right-hand side, on the other hand, looks like a total mess with huge spikes, no clear direction, and just a huge amount of unwanted volatility in its price behavior. This chart is a really good example of why liquidity matters when choosing the symbols or assets you want to trade.